Welcome to China Unveiled. Today, we're diving into the sizzling A-share market as it surges ahead of Xi Jinping's grand military parade on September 3rd. This major event demands a strong stock market performance, and the A-shares are delivering, charging toward 3,800 points. Just days ago, prominent Chinese blogger teacher Li Yongle dropped a bombshell on Weibo. Despite the A-share market hitting a 5-year high, the funds he's held for 5 years are still losing money. This highlights a critical flaw in the A-share market. It's a zero-sum game driven by limited capital. Just days ago, prominent Chinese blogger teacher Li Yongle dropped a bombshell on Weibo. Despite the A-share market hitting a 5-year high, the funds he's held for 5 years are still losing money. This highlights a critical flaw in the A-share market. It's a zero-sum game driven by limited capital. Funds are funneled to prop up the index, so if you're not holding heavyweights like banks, insurance companies, or state-owned enterprises, you're likely a retail investor left empty-handed, unable to profit. This raises a big question. Will the A-share market keep climbing? Is 3,700 points overvalued or still a bargain? How long can this rally last, and could it hit 4,000 points? Let's explore the dynamics of the A-share market. Back in 2014, the China Securities Regulatory Commission, or CSRC, underwent a major overhaul. Between 2012 and 2013, a flood of companies applied for IPOs, overwhelming the CSRC's review process. To tackle this, they scrapped the old Issuance Supervision Department and created a new one, dividing it into 9 specialized offices to boost IPO approval efficiency. To tackle this, they scrapped the old Issuance Supervision Department and created a new one, dividing it into 9 specialized offices to boost IPO approval efficiency. But here's the twist. 4 of those 9 office heads have since been implicated in corruption, making the CSRC's issuance department a hotbed of malfeasance. Recently, Caixin reported that Yang Jiaohong, the former head of the 4th office, arrested last year, had 2 to 3 billion yuan in cash seized from his residence. The last time authorities found such a massive cash hoard was in 2016, when Wei Pengyuan, a deputy director at the National Energy Administration's coal department, had over 200 million 100 yuan notes confiscated. Counting that cash burned out 4 money-counting machines. Curiously, Yang, the CSRC official, resigned in 2016, already steeped in corruption. Yet, years later, he didn't launder his illicit funds or flee the country to escape justice. He just waited for the authorities to nab him, a surprising lack of foresight for someone in finance. Yang's wealth-building methods reveal the A-share market's true nature. As an IPO gatekeeper, he held immense power over companies seeking to go public. He could easily secure pre-IPO shares, use a proxy to hold them, and cash out for massive profits after listing. Yang's actions expose a stark reality. The A-share market is a financing vehicle, not an investment platform. In this setup, financing is the A-share market's core function, with investor returns often an afterthought, if considered at all. Given this financing-driven nature, we need to assess the current 700-point level from that angle. Is it overvalued or undervalued, and can it hit 4,000 points soon? First, let's look at the supply side. Are IPO approvals tight or loose? In 2024, A-share IPOs raised 673.5 billion yuan, the lowest in a decade, with both the number and scale of IPOs halved. This trend continued into 2025 with only 328 billion yuan raised in the first half of the year. This reduced share supply has eased pressure on the secondary market. On the demand side, the rally's main fuel comes from ETFs, especially broad-based and dividend-focused ones. In 2024, domestic ETFs saw net inflows of nearly 1.2 trillion yuan, with stock ETFs accounting for over 1 trillion. In the first half of 2025, non-money market ETFs attracted several hundred billion yuan, mostly flowing into products like the CSI 300, SSE 50, and CSI dividend ETFs. These funds are price insensitive, allocated passively based on index weightings, not corporate earnings expectations. As a result, heavyweight stocks are continually propped up, creating the illusion of a steady index climb. Meanwhile, small and mid-cap stocks get little of this capital, leaving retail investors with a lackluster experience. Next, let's consider capital costs. The yield on 10-year government bonds has stayed below 2% for an extended period. Against this low interest rate backdrop, high-dividend heavyweights like banks, utilities, and state-owned enterprises become attractive safe havens. A 5% dividend yield is enough to draw significant capital, supporting the index's rise. But this isn't a broad-based bull market, it's a structural, superficial one. This rally hinges on tight controls over IPOs and refinancing, which limit new share supply. But the moment regulators deem the index strong enough to loosen these restrictions, a flood of new IPOs and refinancing will emerge, diverting capital and pressuring the index. This is the hallmark of a financing-driven market. Its trajectory depends not on corporate performance, but on regulatory decisions about capital supply. So, is 3,700 points overvalued or undervalued? In the short term, it's not overvalued at all. It could even reach 4,000 points if policymakers keep bolstering the index and maintain strict IPO controls. But in the medium term, once the financing floodgates open and new share supply increases, 3,700 points may look costly. How can we anticipate when these financing gates will open? Here are 3 signals to watch. First, assess the market's catching power. Are enough retail investors jumping in? If retail investors, believing the government's bull market narrative, flood the market and boost trading volume, stabilizing the index at high levels, regulators may conclude that loosening IPO and refinancing restrictions won't tank the market. They'll then gradually ease these controls. If reading market signals feels daunting, just monitor announcements. Track the number of IPOs and refinancing deals each month. A sudden spike means regulators are opening the gates, signaling it's time to exit. Second, evaluate macroeconomic financing demand. If Xi Jinping launches major projects, setting up new state-owned enterprises needing substantial capital, he'll likely turn to the stock market for funding. Economic authorities may then issue statements about the capital market better serving the real economy, encouraging state-owned tech companies to list en masse. But I anticipate China will avoid major new policies in the second half of this year, so Xi is unlikely to suddenly drain the market. Third, observe whether policymakers need to maintain the A-share market's facade for major events. For instance, with the September 3rd military parade approaching, regulators will likely prop up the market to enhance Xi's image. During such periods, the A-share market typically performs strongly. Moreover, China currently aims to sustain A-share gains to retain domestic capital, acting as a reservoir to prevent outflows. This signal is clear, suggesting a short-term push to 4,000 points is plausible. Now, a bold assertion: the concept of a slow bull market is ill-suited to A-shares. A slow bull market needs consistent long-term capital inflows to sustain gradual growth. Historically, 70% of A-share investors lose money, 20% break even, and only 10% profit. Widely seen as a casino, it's not where people plan for retirement through trading. As a result, the A-share market has become a distorted zero-sum arena. The national team can prop up the index, but they can't create a true bull market. Without a wealth effect, they can't attract sustained capital. Relying on hype to draw investors is like a Ponzi scheme, a short-term tactic that can't last, because each one revolves around exploiting retail investors. In the 2015 bull market's collapse, 85% of retail investor households with assets under 500,000 yuan suffered losses totaling 250 billion yuan. Meanwhile, high-net-worth individuals with assets over 10 million yuan averaged a 31% profit, pocketing 245 billion yuan. This shows a clear transfer of wealth from the 85% of retail investors to the top 0.5% of elites, the reality of an A-share bull market. If you're in the A-share market, you need to know its rules. First, forget about a slow bull market. This market won't fund your retirement, even with bank stocks or high-dividend assets. Second, to predict a downturn, watch when the financing gates open by tracking IPO and refinancing activity. Third, A-shares are only good for short-term trading, aligned with policy directions. If you're not holding heavyweight stocks now, you're likely like teacher Li Yongle, holding funds for 5 years and still losing money. Frankly, if you have access to US markets, there's little reason to bother with A-shares at all. Thanks for watching and joining us on this journey to unveil China's many layers. If you found this video insightful, please give it a thumbs up, share it with others, and hit that subscribe button to stay updated. See you in the next video.